As per the data, the number of demat accounts in India rose to 11 crores in January 2023 as compared to 8.4 crores in January 2022. That's a staggered growth of 31% year on year. Now, the reasons for such growth are increased financial literacy, ease of account opening process, increased savings, and good returns in the past stock market. Hello everyone, welcome to Friday First Cut with the new edition of the video. My name is Shanawaz and today we discuss 5 mistakes to avoid while investing into the stock market. Now everyone knows and everyone wants to be rich and make big money, and investing in stock market can be a lucrative way to grow your wealth over time. But when it comes to investing in stock market, it comes with own risk and reward ratio. And in today's video, we'll discuss 5 common mistakes that novice or new investor makes while investing into the stock market. First mistake is do not fall in trap of the recency bias. Recency bias refers to the tendency to give more weight to recent events or information and taking decisions rather than ignoring the big picture. And when it comes to investing, recency bias leads to making wrong decisions by looking at the short-term market movements and trends and not looking at the long-term investment strategy. To avoid falling in trap of the recency bias, it's important to take a step back and look at the bigger picture. This means looking at historical trends, considering the long-term prospect of the company or industry, and maintaining a diversified portfolio. Avoid making investment decisions by following these short-term market movements and stick to your investment plan. Now, the second mistake that investors make is entering the stock market to make quick profits. Now, entering the stock market to make quick gains or profits is a very common mistake that novice investors make. Now, the stock market could be volatile in the short term, and it's not always possible to predict short-term market movements, which could lead you to make impulsive decisions and may expose you to more risk and losses. The reality is that successful investing takes time, patience, and discipline. A long-term investment strategy that focuses on building a diversified portfolio and being invested in the market for long is more likely to succeed rather than trying to time the market and make quick profits. Now, coming to our third mistake that investors make is relying on hot tips. Instead of relying on hot tips, do your own research and make informed decisions based on your investment goals and risk appetite. Consider factors such as companies' health, competitive landscape, and industry trends while evaluating potential investments. And make sure, while making any investment decisions, diversify your investments to reduce risk. Buying stocks and making investment decisions without proper information or proper research is a common mistake that many new investors make. Now, it's important to understand that investing in stock market comes with its own risk, and making uninformed decisions can lead you to significant financial losses. By taking the time to conduct your proper research before buying stocks and maintaining a diversified portfolio, you can increase your chances of success and achieve your long-term investment goals. Now, the fifth mistake is holding on to bad picks and selling winning stocks too early. When investors hold on to underperforming or bad stocks, they are in the thought that the stock price will eventually recover and produce profits for them. But however, this is not the case. When investors hold on to bad picks, they are in the notion that the stock price will eventually rise and make profits for them. However, this may not always be the case. Sticking to underperforming stocks over time can lead to making significant financial losses over time for investors. It's important to recognize when a stock is not performing as expected and cut your losses by selling the stock. On the other hand, selling winning stocks too early could also be a mistake. Investors tend to sell stocks to make quick profits, especially when the stock has risen significantly in a short period of time. However, this could lead to missed opportunities for future growth and potential profits. To avoid making these mistakes, it's important to have a clear investment strategy and stick to it. It may involve making clear profit and loss targets and having a clear plan for when to sell a stock. It's important to conduct ongoing research and evaluation of your portfolio to ensure that you're holding investments that align with your investment goals and risk tolerance. By avoiding these common mistakes, you could increase your chances of success when investing into the stock market. For more such informative videos, do subscribe to our YouTube channel.